I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that's helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different than the news media in America. So let's talk about the 4 things we learned in the markets this week with point number 1. And point number 1 was stocks. They've enjoyed a strong start to the year. However, all the major averages took a step backwards collectively. And that was the first time this happened in 2023, where all 3 of them, the major ones, pulled back for the week. Most pundits are blaming the strong jobs report that we discussed last week, which of course was 517,000 jobs being created for the previous month, and a lowering of the unemployment rate down to 3.4%, as one reasons why the markets are pulling back from here. As discussed at length, a great jobs report is wonderful for the economy. However, it has proven to be problematic for Wall Street. And it's problematic for Wall Street because the potential for the Fed to keep interest rates higher for longer, which puts more pressure on the U.S. economy, slows it down, which puts more pressure on stocks. The derivative markets, which make bets on which way the Fed will go with interest rates, they've scaled back their bets that the Fed will actually lower rates near the end of the year. And of course, the CME Group's Fed Watch tool, which is something that we watch pretty regularly and have talked about on this video series, is now showing a rate increase for March, which has pretty much always been there. But it's also showing a rate increase for the Fed's May meeting, which is a new development. Hence, this week's issues within the markets. And then they're also predicting just 1 rate cut in December of this year. Now, worth watching this next week will be the Consumer Price Index number that's going to come out for January. That's due out. And then this week, we'll see Coca-Cola, Marriott International, and Kraft Heinz going to report their earnings. All good measures for the U.S. economy. Now, for the week, the S&P 500, which tracks our growth and our growth in income stocks, when taken together, was down about 1.11% for the week. The Russell 2000, which tracks our more aggressive growth, smaller and mid-sized companies, that was down 3.39% for the week. And new for this week, instead of quoting the growth-oriented NASDAQ, which I've still left on this chart you're seeing on your screen, we'll track the MSCI EAFE, which is a compilation of all the developed stock markets around the world, excluding the U.S., to give us a proxy on international stocks. Now, for the week, the MSCI EAFE was down 1.05%. And point number 2, zero. Zero is a hard number to understand, right? In some cases, it can be good, such as I have 0 health problems right now. And in some cases, it can be very, very bad, such as your favorite team scored 0 points in the Super Bowl this Sunday. Now, for the markets, 0 is a hard number to understand as well, whether it's economic output, GDP, the growth of our economy being at 0, or corporate earnings flat quarter over quarter. The question is it 0 because of a looming downturn? Or just as Coca-Cola ads used to say, it's a pause that refreshes before the next big cycle of growth. Of course, you and I buy stocks because U.S. corporate earnings have always grown. That is the case for owning stocks, right? More earnings of a company lead to higher valuations, even at consistent multiples. And sometimes you might get multiple expansion on top of earnings growth. From 1992 through 2022, as you can see on your screen, the S&P 500 earnings increased by a compound growth rate of 7.8%. And over the last 10 years, corporate earnings grew by a compound growth rate of 7.4%. Now, over those time frames, the S&P 500 index grew at a compound growth rate of 7.8, that's over the longer time period, and 11.2% respectively, the shorter time period. Now, why do I bring 0 growth up? The consensus of Wall Street analysts right now is expecting earnings growth on the S&P 500 of just 2.4% in 2023, and actually quarter 1 and quarter 2 of this year are expected to be negative 3.1% and negative 2.5% versus the same time a year ago. Basically at the edge of growth and contraction, in the middle, 0. Right now, the market is taking that 0 growth expectation and pricing in that it's the Pause, that refreshes. But this is why it's also so important to watch the quarterly earnings of all these publicly traded companies within your portfolio and within my portfolio to see how the story plays out. Certainly, we'll continue to watch that and report to you the earnings of the companies we think matter on this video series right here. And point number 3, let's talk about wage growth. Getting you a raise that you deserve. The latest job report I got me all excited about last week not only showed impressive numbers of jobs being created for the last month, it also showed that wage growth, while slowing from its historically high peak in August of last year, is still elevated. Now, oftentimes on this video series, you hear me talk about the Atlanta Fed's GDP Now model, which gives us a pre-look at what GDP might end up looking like before it's reported. However, they also have, the Atlanta Fed, have a wage growth tracker. When reviewing that data, with the help of my friends at DataTrek here, we're finding some interesting points. First of which is the 3-month moving average for wage growth was 6.1% last month versus the record of 6.7% in August of last year. So starting to come down. Before the pandemic, the March of 1983 was the highest we had ever seen, and it was around 6.1%. As you can see from the chart on your screen, wage growth normally only contracts after a period of sustained growth, and then a recession comes through, wipes out all the job market, which puts downward pressure on wages. Some good news this time around, we're starting to see that wage growth decline even while getting very strong economic data. Now you might be asking, seeing wage growth decline, is it a good thing? I mean, that feels like that should be a bad thing for your personal situation. How can I be so rude as to say you shouldn't get raises or not getting raises is a good thing? Well, the problem is this. It only exacerbates inflation issues. So when you've got inflation, you got wage growth, you got more problems. Hence, our need to slow down wage growth a little bit. Diving deeper into the numbers, we see wage growth is strongest for the job switchers. So you want to get the best raise, you actually probably need to switch your job. Wage growth for job switchers fell, but was still at 7.3% last month, with a high of 8.5% in July of 2022. And wage growth for job stayers edged up a bit, but only came in around 5.3% last month versus the record high of 6.1% in June of 2022. And point number 4, if you're not bullish about the innovation of the U.S. economy, then you're probably just a pessimistic person, or you haven't had anybody tell you about it. So let me be your friend and tell you a little bit about it right now. Although, of course, I do have my periods of frustration as well. One man that probably will inevitably go down as the Albert Einstein of our generation is Elon Musk. Let's talk about Elon Musk and one of his companies, Starlink. Okay, now what is Starlink? Well, Starlink is an internet service provider that uses a constellation of satellites in low Earth orbit, what they call LEO. And according to their website, their goal is to offer access to high-speed, low-latency internet on an as-needed basis at any destination where Starlink provides coverage. So it's internet from the stars. Here's the interesting thing. Is Starlink the first company to try this? No, not by a long shot. A few have come before them, and they're all bankrupt today. But Starlink is different. Starlink is different because just last quarter, they actually had positive cash flow, meaning they weren't losing money for the quarter. And that, a company that makes money, is a great thing. That means it's sustainable. So far, the company has launched 3,500 satellites into orbit with an eventual goal of 42,000. The more satellites, the better the service is what that equals. And it began offering its service to residential customers only in October of 2020. And it has continually expanded its offerings to now enterprise companies, RVs, aviation, you got a nice boat, military. In addition, just last year, they launched a partnership with T-Mobile, you might have seen, where they effectively eliminate cellular dead zones for T-Mobile customers with their satellites. Their customer base has consistently grown from about 145,000 users in January of 2020 to about 250,000 that March, 500,000 that June, and 1 million by December. And they're not just offering satellite service in the US. With satellite-based internet, you can be a customer anywhere in the world. Do you wonder how the Ukrainian government kept internet service when their infrastructure was blown apart by Russia? That's my friend Elon Musk doing that. Now, here's one reason why Starlink has been able to not go bankrupt before becoming cash flow positive just last year, as we talked about. They are owned by Elon Musk's other company, SpaceX. who is able to launch reusable rockets into space, therefore significantly lowering the cost of getting all those satellites into space. Look for Starlink to go public around 2025, according to what Musk has publicly put out there. However, because they just became cash flow positive last quarter, quicker than expected, and expect to maybe turn a profit this year, that could change how quickly Elon Musk takes Starlink public. And that would be a good thing for not only the US being able to get satellite or internet service wherever you are, but think about those places that are out in the middle of nowhere, whether they're out in the middle of nowhere because they're just a poverty stricken country, or you just live in the middle of nowhere in Montana, and being able to get internet service wherever you are. That is a disruptive technology that will grow and grow and grow, as we've seen last year, where they went from 145,000 customers to 250, all the way up to 1 million, and continuing to grow. My friend Elon Musk is a disruptor, an innovator, and somebody that's changing the lives, not only with the thing we know about Tesla, but some of these spin-off companies as well. And that is exciting to see, because it shows how innovative the US economy, the greatest economy that's ever been created, and let God continue to bless it, but how great our economy is with all that innovation. So if these 4 points helped you this week, would you do us a favor? Would you click on the subscribe button? The subscribe button allows you to continue to get our videos as we release them, as well as hit the like button. The like button goes through YouTube and Google's algorithm to kick our content out to more people, so that more people can live and give like no one else. And should you want any help, you can certainly go to the comment section, where we have a link to schedule a meeting with any of our financial coaches. Our financial coaches are folks who will help you get through baby steps 1, 2, and 3. Build a budget, get out of debt, make sure that you have somebody holding you accountable, or our financial planners who will help you work through baby steps 4, 5, 6, and 7, so you can live and give like no one else. Thanks so much for watching this week's video. We'll see you next week.